Hi, I'm Richard Hemming, founder of Under the Radar Report. Today, I want to show you how you can generate 24% a year return from 14 stocks. That's right, you heard me right. In short, how buying a portfolio of stocks beats an ETF every day of the week. So last week, the two stocks airlifted into the ASX 200 were Nick Scali and Austal. So that made us very happy, and our members will be familiar with these companies because we first tipped Nick Scali at $1.40 back in 2012. Well, Nick Scali today is over $19. Austal, we recommended it a year later at 62 cents. Today, trading over $6. Add in dividends and you're looking at tenfold plus returns over that period. So phenomenal. But the question is, which stocks that are under the radar are going to be among those in the ASX 200 in a few years? That's right. The point is, do you want to be an index leader or do you want to be an index follower? That's summing it up. Let's look at the facts. Term deposit, what does that return? 3%. Average return since 2001 from the S&P ASX 200, what do you think that is? It's 3.8% a year. If you invested in CBA, BHP, CSL over that period, what would your return be? It would be over 12%, about 12.2%. The return of Under the Radar's fund since inception in 2011 is over 9% a year. This return has been accelerating. So we've returned 24% a year over the past 2 years. Our three recent small cap dividend portfolios have returned 19% a year since early 2023. You heard that right. What has the All Ordinaries done? 7% a year. So if you leave your money in a bank, the costs, the low interest, means that you're going to go backwards in terms of spending power. Similarly with ETFs, look, there are costs. They have their part to play in portfolio management, providing fantastic diversification. But what are the costs? The costs are that you're not getting much of anything. You own everything, but you have exposure to basically sentiment. So that is not the way to generate real wealth. Look, in tranquil times, ETFs do hold their own with stock picking, but we're not in tranquil times. That's why the stocks in our funds are performing so well. Look, to make money, the way to do it is to pick quality stocks at value prices. It's simple, but also to hold on. Patient capital is the key. Short-term thinking misses the point about making money. Investors who chase the index, by definition, have an outlook that is too short. What you want to be doing is buying stocks that are going to be in the index in a few years. Look, what you want to do is you want to be getting that triple whammy effect. You want to be buying stocks that are growing earnings. You want to be buying stocks that are then re-rated because they've delivered this, so a multiple re-rating. Then the kicker is getting into an index. That's how you get your returns. That's how you get your Austals. That's how you get your Nick Scalis. You don't get them when they're in the index, you get them when they're before. You get them a few years before. That's what we're looking for. Individual investors have the competitive edge. Buy cheap and be patient. That's our motto. We're not chasing the index. We're just looking for returns. We can utilize the growth that you can get from patient investing, plus you can utilize the big ASX benefit of dividend and the tax credits associated with dividends by buying stocks on the ASX. So what do? It's simple. Access our shortlisted ASX best stocks to buy. The sooner you start, the better.